Joining us now from San Antonio, Texas, is USAA Investment Management Fund Manager Matthew Freund. Matt oversees $7 billion in bond funds, and overall, USAA has nearly $50 billion in bond funds under management. Matt, good to have you back on the program. Sarah did a great job of sort of outlining the bond market reaction, which has been a little puzzling, really. What do you read into these Treasury yields?
Well, when you look at what's going on in the Treasury market, there was an initial burst of euphoria, short-term market relief that a deal was in sight, and we think it still is. It's been our long-held position that a deal will get done. That said, it is clearly a glass-half-full economy. At some point, we're going to have to stop calling it a soft patch. That, coupled with what's going on in Europe, I think is giving investors pause for concern, regardless of what happens today and tomorrow with the vote in Washington.
So, Matt, let me get this clear. You see rates continuing to go up?
Well, from today's levels, I think it, again, we had quite a rally. It wasn't too long ago that folks were shocked that we were breaking below 3%, and now we're quite a bit below that. So if the deal gets done, if it gets signed, I think you're going to see a relief rally that's going to flow through. Stocks will do a little bit better. Rates will probably go up a little bit in the near term as all that money that was pulled to the sidelines comes into the market and finds a home.
Matt, you must have played out different scenarios, right, with this debt situation. So as you walked into the offices this morning, I mean, what do you think about buying? What are you thinking about? How are you going to trade this?
Well, it's very difficult to trade an event like this. I mean, we spent the weekend, I thought I'd be watching baseball, and instead we're watching a political chess match, and it's very tough to tell who's winning. So in terms of trading around what we've been seeing the last couple of days, very, very hard to do. We've always felt that a deal was, in the end, likely to occur. And again, I think we have to be careful about the words we use. Words have consequences. I don't really think a default on U.S. Treasury obligations was ever really on the table. So that being said, at USAA, we keep to our long-held view of making sure we're being well paid for the risks we're taking. There are some areas that we still like. We still think high yield can make sense for part of your portfolio. Again, 5 to 7% type of returns. Long munis look pretty good here, despite what we've seen in the long end of the curve. And we think that high-quality stocks, stocks with fortress balance sheets paying a decent dividend, could do pretty well. So one of our key messages to investors, there's always opportunities. Make sure you're being paid for the risk, and realize that with some of the uncertainties, you need to moderate some of your return expectations.
But, your world must have changed, not you per se, but I'm saying if you're a Treasury holder, though, your world must have changed a little bit with this. I mean, what is the difficulty that if you're a big Treasury holder, that you're going to have from here on out until this downgrade threat is resolved?
Right, the downgrade. Well, that's something that, now remember, the downgrade was put on the table back in April when it first came up that if we didn't get our house in order, a downgrade would occur, or could occur, I'm sorry. So, the first thing I'd point out is that at very high and at very low levels, it's hard to distinguish between what the ratings actually mean. So the difference between a AA plus or a AA and a AAA really is going to be very, very modest outside of bragging rights, and that's true on the low end as well. So if you told me with absolute certainty that we're going to AA plus or AA, I don't think the impact would be nearly as severe as some of the commentators are talking about.
Really?
Short-term rating.
Matt, you mean you wouldn't be seeing, obviously the value of it would go down, though, would it not?
Well, on the margin, it would, just so if nothing else changed. But remember, short-term ratings are not expected to change, so there shouldn't be any dramatic forced selling. So that's number one. Number two, the U.S. remains one of the strongest, most dynamic markets or economies in the world. The liquidity in the Treasury market is enormous, and there's not a lot of places for investors to go, large institutional investors. And I do think it's kind of ironic that if we do start addressing these problems, I actually feel better about Treasuries in the long run if we address the problems now than I would if we kept kicking the can down the road. So if we get the details here, the deficit reduction is immediate, front-loaded, we're seeing some progress. Regardless of the debt rating, I think Treasuries are still going to be seen as a safe haven.
Okay, Matt, thank you. Appreciate it. Matt Freund of USAA.